Hi, welcome to Tab's 2 Cents, the show where we talk about finance, business, and achieving success. Today on the show, we have Peter Sainsbury. Peter is a returning guest and the founder of Carbon Risk, a great Substack for anyone interested in carbon. Today, we're going to talk about carbon. We're going to talk about the implications on the carbon market from the Russian invasion into Ukraine. And I think it's important to note that truly this is a humanitarian crisis. And first things first, we need to consider the loss of human life, both in Ukraine and in Russian military personnel that perhaps aren't there for any reason other than being a part of the Russian military. Nobody needs to see loss of life. It's a tragic event that's unfolding. And war is something that I didn't think I would see in Europe in my lifetime. And I'm very upset that I have. So with that being said, if you're Canadian, federal government has announced that they will match any donation to the Red Cross Ukraine campaign. So I'm going to go ahead and link out that donation page in the show notes. So hopefully you enjoy the show. We still need to discuss our investments. We still need to talk about our hard-earned dollars and what can happen to our money as a result of this war. So I think it's important to compartmentalize both the war and our finances. So with that being said, I hope you enjoy my discussion with Peter. We cover a lot of topics, both from a geopolitical stance and a commodities and carbon market viewpoint. Enjoy the show.
Welcome to Tab's 2 Cents, a show for average Joe investors where we talk finance and how to achieve success.
Peter, welcome back to the show.
Thanks, Jay. Thanks for having me back on the podcast.
Yeah, and a lot has changed since the last time you've been on. And I really wanted to get you on to talk about carbon, commodities, markets. I know your last blog, you sent out collateral damage. You highlighted the 4 areas in which the recent events could affect carbon prices. I don't know if you want to talk about that quickly.
Yeah, that's right. So, I mean, clearly it's first and foremost a humanitarian crisis that's unfolding in Eastern Europe at the moment. But as investors, we clearly need to consider the implications for our investments. Now, from my piece was kind of sparked really from what has kind of materialized over the last few days, and kind of what I see as the potential downside risks to carbon markets going forward. And really there was as you mentioned, like four things that could differ in terms of their ferocity and their immediate impact, and they're really kind of the sort of financial, economic, political, and kind of social impacts, and then how those 4 factors kind of feed back on themselves and impact the carbon market. So the first one was really kind of the sort of financial impacts, and then really back in only Thursday last week, there was a massive sell-off in EU emission allowances, literally when the market opened in the morning on that Thursday. And there was a massive gap opened up in the chart. And what tends to happen when there's kind of volatility spikes in the energy market is you get these kind of margin calls, and the carbon market is quite a liquid market, and it's not something necessarily that utilities or hedge funds need for their day-to-day operations. So it's something that can easily be sold, and that's what we saw really on Thursday morning when the price dropped by around about 10 euros per ton within in the space of one day. What is likely to happen, what we've kind of seen subsequently over the last few days, is that trend towards margin calls accelerates, and people offload emission allowances that they've perhaps got on their books. And part of this has been sparked by the tightening in restrictions on the Russian economy, in terms of Western sanctions, either through the restricting access to the SWIFT payment system, but then also perhaps looking forward in terms of either through sort of self-sanctioning or formal sanctions not to buy Russian gas and other energy sources. So of course that's put up the price of oil and gas and coal, which would have completely messed with a lot of hedge fund books, and that has precipitated those margin calls that we're seeing. Next is kind of like the economic impacts. So we've kind of really had 3 or 4 really large negative economic surprises when the carbon market, the EU carbon market has been open. So that's began in 2005. And then we had the great financial crisis in 08 and 09, the European debt crisis in 2011, 2012, and so on. And then more recently, obviously COVID back in the last year or two. So each of those times, we've seen the price of carbon drop massively. There's been various different reasons and market context behind that. But in a sense, if there's less economic activity, less emissions, you've got less need to buy carbon allowances, and that reduces the support in the market. And what we're kind of seeing is people perhaps anticipate that the crunch on energy supplies in Europe is going to be so much more acute going into the summer and next winter that the options potentially include either voluntary or forced industrial shutdowns, and which would then clearly reduce demand for gas, but it also reduces demand for emission allowances as well. And then it's kind of all mixed together as that kind of political picture as well, and it's a very sort of cloudy picture, and because on the one hand we've seen very rapid decisions by different EU member states, particularly Germany, where they've from a geopolitical point of view, they've reversed a sort of generational level decision not to export lethal weapons to other countries. They've openly talked about delaying the nuclear shutdown, which has been legally binding for the last over a decade now, and even reopening coal plants as well to help meet that demand. So these are things that we really couldn't have imagined even a week or two ago. And so just on those things, it's difficult to disentangle what the impact is going to be on carbon. On the one hand, more nuclear means less demand for fossil fuels, but on the other hand, if there's more coal being burnt, that increases the demand for emission allowances. But it's all also kind of wrapped up in this wider perspective on what's going to happen to Europe's climate strategy. Clearly, reducing reliance on fossil fuels, cutting emissions is very much closely related to trying to distance ourselves from Russian gas. The two align quite well. But what we potentially could see is a ramping up in kind of state mandated acceleration in renewable energy, resource efficiency, energy efficiency, which up until now has been really kind of left to the market. And the EU ETS has been the tool to help accelerate that transition. So if we're now getting to the point where the state is kind of trying to push it that at lightning speed, then what do we need the emissions trading scheme for if it's all being state directed? That's an extreme scenario, but it's something I think people potentially are considering as being an outcome of the next few months and years. And then kind of wrapped up in that whole sort of climate versus energy security and geopolitical perspective is the social angle. Now it's become blatantly obvious that Europe receives such a significant share of its energy needs from Russia, whereas a few weeks ago many people wouldn't have necessarily realized that. And now everyone knows it's at the whim of one man. Will Europe's citizens their priorities change? And that's a delicate balance, because renewable energy will take time to bring on, no matter what the state funds and and ambition behind it. So I think it's accelerated things that are going to are happening anyway, but it's still very much undecided what's going to happen. And I think that all that uncertainty, financial and economic risks, has been weighing on the carbon market over the last 10 days or so.
Yeah, there's definitely a lot to unpack there. One thing that I wanted to ask you about, because I know you're a commodities guy first, the price of oil, I mean, we're in triple digits, both Brent, WTI today. Do you think that you could see some of those industrial oil producers using that excess money to buy carbon allowances?
Potentially. I mean, if you're talking about OPEC members or other it really depends on the extent to which they're attuned to ESG mandates. If it's a state, Saudi Aramco, they've got no sort of pressing need to satisfy their shareholder expectations over offsetting their carbon. Whereas if it's potentially some privately held producer in South America, for example, then potentially that's an opportunity for them to use as extra funds to help offset their carbon risk.
Just a thought that I had in regard to higher oil and with carbon, and there's going to be some implications for excess fossil fuels that they're going to need, and all of these other areas where they're going to pump out their energy. One thought that I had as far as energy security, it's much easier for a country to protect their assets when they're not all confined to one large plant. So what do you think about that with renewable energy? Do you think that governments have thought about this already?
Yeah, I mean, to an extent, renewable energy does allow some self-sufficiency. While one country could rely on solar, another can rely on wind, wave, whatever. So to some extent it allows more decentralization to some extent, but clearly the sun doesn't always shine during the day, so you need to redevelop the grid to potentially allow excess energy during the day to be exported to regions or countries where there's a deficit of energy. So this is a mammoth task. It doesn't mean we can all become less interdependent on each other. In many respects, we need to become more dependent purely because of the grid. I think the other important point to note about the growth in renewables is it's still very much commodity dependent. So you need rare earths, lithium, all of those other kind of very sort of scarce and becoming increasingly valuable commodities. So we're to some extent replacing dependence on one type of commodity, fossil fuels, onto another. And there's geopolitical risks in that as well. We might be trying to replace our reliance on fossil fuels from Russia, but instead we're changing that reliance to China in terms of some of those raw materials.
Yeah, I think that's a good point. The raw materials or the fuel or whatever commodity we need, it all boils back to you have to get it from somewhere. Yeah. And it's not always Europe's ability to get that for themselves. I know here in Canada, North America, we have lots of resources, but we don't necessarily have the financing to mine them all either. So it's not like we can just all of a sudden have a major lithium mine to produce a ton of batteries. So
and that's right. And I mean, it's important to note it's also, even if you've got the raw material, you actually need to process it into a chemical or a raw material that actually you can use in the final application. To take lithium as an example, you might have a lithium mine, but if you don't have the processing ability, such as like China has, then it's not really necessarily going to do you any good.
Yeah, and one blog that you put out was the impact that a recession could have on carbon. And if we continue to see commodities rise this fast and funding going into military areas, and for whatever reason a recession was to occur due to this elongated war, what do you think the impacts would be on carbon from that?
I think as I kind of mentioned, I think there's on the demand side, clearly if economic activity slows or even declines, that might imply there's going to be lower emissions, so less demand for emission allowances. So that could result in lower carbon prices. Indeed, that's what we've seen over the sort of previous 3 kind of big economic events we've seen in the EU carbon market. But I think there's an important caveat to that, in that the carbon market has changed completely, really, from what it was 10, 12 years ago, in that there's an inbuilt mechanism called the market stability reserve that essentially works to kind of siphon off excess supply every year. It every year it reduces that excess supply by about 24%. Excuse me, that's an inbuilt mechanism that was launched in 2019 to help reduce the excess supply that built up over over the previous decade or so. What it does represent, in a sense, is it's a kind of a self-balancing mechanism, so that if a recession does hit, which could, is becoming increasingly likely, there might be, a hit to demand for allowances in the near term, but that just means that the MSR, the Market Stability Reserve, helps to counteract that cut in demand in future years. So what you normally see in normal circumstances is that the market isn't just focused on the here and now; it's focused on the what's going to happen over the next 1, 2, 3 years and beyond. The actions of the MSR should be factored then into present day prices. If you look back at what happened during COVID, there was a sharp sell-off of around about roughly sort of 20% from memory, which was a lot less than in previous episodes. But then we got a very quick rebound, which kind of mirrored what happened to other asset prices, but it also kind of mirrored what the market was expecting about that kind of gradual tightening in the supply of allowances over time. And there's no reason to suspect that will change going forward. This is all kind of locked into EU legislation. There's bits around it that are being debated, this year, but there's no reason to think that any of that will change going forward.
Yeah, I really think that the largest tailwinds and headwinds potentially moving forward for carbon will be in investor confidence and industrial confidence in the pricing and what they do with regulation, because as we all know, in war, sometimes laws get changed. And if, like, for example, Zelensky just came out and said he's going to release prisoners with combat experience, which is obviously unheard of under normal times. So it's not really a stretch for the imagination to think that Europe could change their carbon laws to allow for cheaper industrialization.
It's we've seen lots of things, and things that we would have thought would be, improbable become possible over the last week or so. So you're absolutely right. Things, it's something to watch. Again, it feels unlikely, but it really is something to watch out for.
Yeah, and I think if they, at the same time, if they don't change the laws, even during a crisis, that could really embolden some investors and industrial areas to buy more credits and to take advantage of the dip that we're seeing now.
Yeah, and that's right. So that's the flip side of it, is if you've got the confidence that the EU will stay the course and recognize that even though they might try and ramp up other aspects of climate change and fossil fuel abatement that that they might have some control over, that the path that they've set out in terms of emission reductions and the role of the EU carbon scheme has in that, if you think that's going to stay the same, then potentially they're going to be, as the carbon price unwinds, could be some interesting opportunities going forward.
Yeah, and I think one thing that I've sort of been considering is some people look at carbon as sort of like a negative commodity, like there's only so much room in the atmosphere before we're past the point of no return. And what's happening in Russia is taking away some of those spots. And I saw a video of an oil refinery that was lit on fire for whatever reason, and that's just spewing carbon into the air. So if we're in the position we're in and the science is determined, it's going to be pretty hard for them to change course, I would think, on carbon.
Yeah, absolutely. And it's it would be I've kind of described the carbon market as a not necessarily a commodity, but more almost like a currency, like the currency of decarbonisation. Just like investors have lost trust in the Russian ruble over the last week, if you lose trust in currency of decarbonisation, which is the carbon price, then the price collapses, and investors never come back potentially. So that's the real risk that the European Commission faces. Should they, however unlikely, tamper with the carbon system, the carbon market, sorry. So if your expectation is that they wouldn't do anything as stupid to mess with it, then again, as you're saying, it's going to throw up some interesting opportunities to back that commitment.
Yeah, for sure. And from what I understand is people are speculating that most of the sales have been either industries monetizing their free allowances or speculators getting out of the market and moving into, I'm assuming, something like oil, perhaps. You recently released a blog on options and the headwinds and some interesting activity that you've seen. I wonder if you could just talk about that a little bit.
Yeah, that's right. So just like any other commodity market or asset market, option market plays a pivotal role in the carbon market as well. And up until maybe even sort of 3 or 4 weeks ago, there was a lot of sort of core market activity that would, we was looking at sort of very bullish prices, beyond 95 euros a ton. And the expectation was that when or if prices had carried on beyond that point, then institutions that had written those call options would have had to have gone into the market and bought the underlying asset, so the either the physical carbon market or the EU futures contracts, and that would have helped push the price up towards that option market expiry value. But what we're seeing now is almost like the reverse, and it's might become an increasing headwind, in that prices have dropped below that kind of key 80 euro per ton mark. Between 80 and 85, there was a lot of activity that was kind of a net bullish position, but now prices are below that level, and if they stay below that level, and perhaps the expectation is that there might be more selling, is that we could then see a reversal of that process. Instead of institutions buying the underlying asset, the carbon price, they could be more and more selling. Has the impact of kind of accelerating moves on the upside, but also the reverse on the downside as well. So we've seen a kind of a net sort of swing towards a more bearish sentiment in the options market over the last 2 or 3 weeks. So it'll be interesting over the next day or so whether that 80 euro per ton level holds.
Yeah, absolutely. It's something to watch. I wonder if we can transition over to commodities, oil and natural gas specifically. I wasn't really looking or watching markets when Russia went into Crimea. I'm assuming that just based on your book that you were. How does this differ from that? It's obviously a much larger scale. And if you can recall, what do you remember happening when Crimea was as far as they went?
Yeah, I mean, as you say, it's a very different scale. I mean, the energy market was in a very different position then. And I forget exactly when that invasion happened, but now, clearly now, energy markets are already very tight. You mentioned oil over $100 a barrel, very high gas and coal prices. But going into the back end of 2014, we had the oil price collapsing, and so it was very much a different picture in terms of the supply demand dynamics. In a sense, now Russia's in a position of strength because of high commodity prices and the extent to which they have and are able to access those reserves that they've built up over the last few years. Whereas going back 5 or 6 years ago or more, back when it was Crimea, it was a very different picture. There was more of a weakness. Putin had a weaker hand back then. So that's probably the main differences in terms of where we are today.
Yeah, we've underfunded the oil industry for the last decade or so, some would argue. And perhaps that's why we're seeing the prices we're seeing now, because I know here in Canada, I have some friends in Alberta and they work on the oil rigs in the sands, and a lot of them have had to leave because they've been shutting down those rigs. So, 10 years ago, they probably could have just ramped them back up and increased production, but now they've all been shut down and disabled.
I don't know whether it's going to change public attitudes, but that we've kind of let ourselves become into the position we are today, essentially because as you say, we've divested from oil, gas, and other fossil fuels. It's become almost like a sin stock. No one invests. It's uninvestable, or you can't be seen to invest in fossil fuels. So that's kind of taken away our leverage. In these kind of situations where previously we could have been able to manage the supply side of it. What we're going to have to do now is probably manage the demand side, and that's where, might be curbs on industrial activity, switches between different fuels, depending on what's available. But that's going to be a big hit to, households, businesses. You're going to see squeeze on, consumer income, real incomes, margins on from companies that can't offset those increasing costs. So all of which kind of comes together with, that kind of sort of quite bleak kind of economic outlook as well.
Yeah, for sure. And one thing that I have found just in my research is that Canada's the number one producer of potash, and Russia and Belarus are 2 and 3. So there's obviously going to be a supply demand increase on a commodity like that, where Russia and Belarus are most likely going to be sanctioned, and it's going to be hard to get that product out of there. Are there any other commodities that we could be looking at?
Yeah, I mean, as you say, just on those, it's not just because of sanctions. It's potentially because of restrictions in the the ports in Ukraine or elsewhere in the Black Sea that might prevent that commodity coming out. But things like palladium and platinum, Russia is kind of key producer of those commodities. Aluminium as well. Agricultural based, so wheat especially. Ukraine and parts of southern Russia are kind of the sort of the breadbasket of the world in many respects. So we're already seeing wheat prices hit massive, well into record levels this morning, on the fear that that wheat won't be able to come out of that that region. We're going to have to rely on exporters elsewhere in the world. Yeah, I think those are probably the main ones that investors should be aware of.
Yeah, I agree. Could you just maybe talk quickly about the SWIFT payment system and what do you think that's going to happen, or what implications that's going to have on the global market?
The SWIFT, Russia's been blocked from the SWIFT payment system, which is it's more like a sort of messaging service that helps to track payments across borders. As I understand it, a number of banks and other institutions in Russia have been blocked from the system. So what it could mean is that countries in Europe or elsewhere that need to deal with Russia, may not be able to use the same payment rails that they have at the moment. It would certainly add much additional cost in terms of being able to be able to facilitate that payment. I think the other related aspect to it is that it will force companies that aren't necessarily sanctioned to potentially self-sanction themselves and say, we use this SWIFT payment system to work with Russia, but we fear sanctions upon ourselves, so we're not going to interact with Russia even if we can. That's one potential outcome. I think the other one is there's a suspicion going back into last year that Russia and China had developed a kind of a sort of parallel payment system. I'm a little bit unclear as to how that has evolved, or the degree to which they can actually use it. But potentially there are other routes to which Russia might be able to use. What we're seeing though is, even though SWIFT is a kind of the official means by which trade would have been done with Russia, the fact that other countries, other companies are saying we're not going to deal with Russia, we're going to sell our assets that we have in Russia if we can. I think that is probably the more powerful factor in terms of closing off trade with Russia.
Yeah, absolutely. So with that being said, I think that we've covered a lot. I mean, it's also fluid. It's going to be really hard to predict anything with any level of accuracy, but it is important to think about different ways that this can go and how investors should protect themselves, because after all, these are our hard-earned dollars, and it's a humanitarian crisis, and it's everything that's going on over there is very tragic, but at the same time we still need to think about how our investments could be affected. And I just want to say thank you for coming on the show in these tough times, and hopefully in the UK you guys are doing well, and All the best.
Yeah, thanks, Joe. Thanks for talking again. It's been good.
Yeah, is there anything you'd like to add, or?
Just to follow up on that point, actually, is that speculators and investors sometimes get a bad rap sometimes, but we're trying. The carbon market is all about trying to find the right price of carbon to help accelerate the fight against climate change. Investing in carbon, commodities is all about trying to facilitate the global trade in commodities, so that there might be a shortage for a certain period, but that causes the price to go up, and then either demand or supply responds to to that price. So we're in a difficult situation at the moment where we're having to react to a humanitarian crisis, but it's got important implications for all of our everyday needs going forward.
Absolutely. Yeah, thanks again, and stay safe.
Okay. Cheers, Joe. Thanks.
Joe is not a financial advisor and may have interest in the stocks discussed on the show, so do not take any information included within this podcast as a recommendation or formal advice. Thank you.